Welcome to the Fingraph India channel. Let's jump right into today's explainer because we are looking at absolutely the most crucial part of the Income Tax Act. It's Section 4. You can really think of Section 4 as the literal engine of the entire tax code. Without it, the government has literally zero power to collect a single rupee from your earnings. It is the absolute core legal basis for income tax.
Look at this single page. It comes straight from the Ministry of Finance, and it is the bedrock of the entire legal framework for income tax collection in India. It's Chapter 2, Basis of Charge. Now, it looks incredibly brief, right? It's literally just 5 short subsections. But the legal weight these few sentences carry is massive. Every single tax calculation, every deduction, and every collection mechanism stems from the authority granted right here.
Here's our roadmap for today's explainer. First, the foundation of income tax. Second, who and what gets taxed. Third, additional taxes and timelines. Fourth, paying at the source. And finally, final thoughts and next steps.
All right, let's dive into Section 1, the foundation of income tax.
So, here is the exact verbatim text of Section 4, subsection 1. It says, where any central act enacts that income tax shall be charged for any tax year at any rate or rates, income tax for such tax year shall be charged at that rate or those rates in accordance with and subject to the provisions of this act. I know, that's a serious mouthful. Let's just let that dense legal phrasing settle for a second before we break it down. Let's translate that legal architecture into plain English, shall we? The central act they're talking about here is typically the Annual Finance Act. You know, the one the government passes every year to set the specific tax rates. But that act needs an engine to actually enforce it, and that is exactly what Section 4.1 does. It effectively says, hey, if the government sets tax rates for a year, this specific Income Tax Act is the legal engine making the collection of those rates fully enforceable. It perfectly bridges the gap between a policy decision and a rock-solid legal mandate.
Moving right along to Section 2, who and what gets taxed.
This brings us to Section 4, subsection 2. It states, the charge of income tax under subsection 1 shall be on the total income of the tax year of every person as per the provisions of this act. Now notice those crucial legal keywords there, total income and every person. The law doesn't just casually say salary or profits. It uses a very specific, all-encompassing phrase.
So what does total income actually mean for us in practice? Well, let's use an example. Imagine Person A. Person A works a corporate job and earns a nice monthly salary. But Person A also runs a side hustle selling crafts online, which brings in a separate profit. The law right here mandates that all of it, the salary and the business profit, is bundled together. That combined sum is Person A's total income. The government isn't looking at these in isolation. They group all your chargeable earnings for that year into one big bucket to calculate the final tax you owe.
Next up, Section 3, additional taxes and timelines. Section 4, subsection 3 reads, income tax shall also include any additional income tax, by whatever name called, levied under this act. I want you to pay very close attention to that phrase, by whatever name called. This is honestly a brilliant piece of legal future-proofing by the drafters.
Here's why that matters in the real world. You have your standard income tax based on regular rates, but sometimes the government decides to introduce extra levies. They might give it a fancy special name, like a surcharge or a specific fund levy. What subsection 3 clarifies is that legally speaking, it doesn't matter what they call it. If it's an extra charge levied under this act, it all falls under the ultimate enforceable authority of income tax. There's absolutely no loophole just because the charge has a different title.
Then we have Section 4, subsection 4, which says, if this act provides that income tax is to be charged in respect of income of a period other than the tax year, it shall be charged accordingly. Usually, tax is calculated on a standard full tax year. But, as we all know, life doesn't always fit neatly into a 12-month calendar. This clause provides the legal flexibility to tax income outside that standard yearly timeline.
Let's look at a practical example of how this flexibility is used. Say Person B is running a business, but they decide to close it down entirely just 4 months into the new tax year. The government doesn't want to sit around and wait until the end of the full year to settle taxes for a business that literally doesn't exist anymore. Thanks to subsection 4, the government has the explicit legal right to step in and apply the tax rules specifically for that short 4-month operational period.
Which brings us to Section 4, paying at the source.
Up to this point, we've really only talked about the theory of the tax charge. the rules of what gets taxed and when, but how does the government actually get their hands on the physical money? The final subsection reads, "For the income chargeable under this section, income tax shall be deducted or collected at source or paid in advance as provided under this act." This completely shifts our focus from the abstract legal theory to the very real mechanics of money collection.
And this brilliantly illustrates the real-world flow you probably experience every single month. Step 1, the income is generated. But before you even see it, Step 2 happens. The tax is deducted right at the source. Finally, Step 3, the remaining net income is paid out to you. If Person A earns a salary, this clause is the exact legal reason their employer is mandated to calculate and deduct the tax before depositing the rest into their bank account.
Now, there's a really important distinction authorized by this single clause. Deducted at source means the tax is taken out automatically by the payer, like your boss, before you even receive the money. But the clause also mentions being paid in advance. This covers situations where taxes aren't perfectly deducted at the source, say for our business owner, Person B. In that case, the law imposes an obligation on Person B to proactively calculate and pay their estimated tax to the government in advance as they earn it throughout the year. Both of these massive fundamental collection mechanisms are birthed right here in subsection 5.
Finally, Section 5, final thoughts and next steps.
So to summarize all of this, Section 4 is the definitive legal foundation of the entire system. It establishes the what by defining the core power to charge tax. It establishes the who and how much by mandating the bundling of your total income. It secures the government's authority to add extra levies under any name they want, gives them the flexibility to tax odd time periods, and finally, it sets up the powerful mechanisms of collecting that tax right at the source or in advance. It truly is a masterpiece of comprehensive legal drafting, all on a single page.
I want to leave you with a provocative thought here. Since Section 4 is the unquestionable engine of the tax code, and it clearly mandates the bundling of all income and the strict advance payment of taxes, are you ensuring your own total income reporting is fully compliant? Understanding these foundational rules isn't just theory, guys. It's the very basis of keeping your own financial engine running smoothly and completely legally.
Thank you so much for joining us for this explainer on the Fingraph India channel. If you found this breakdown of Section 4 helpful and clear, please hit that like button right now. Share this explainer with your colleagues or friends who could really benefit from a better understanding of tax fundamentals. And make absolutely sure to subscribe to our channel. We're dedicated to bringing you more focused legal and financial breakdowns just like this one. See you next time.